Hi, this is Ian King, Senior Research Analyst at Banyan Hill. In today's Sovereign Investor Daily video, I'm going to talk about what could potentially send the market lower in the coming months. Now, if you look at this chart of the S&P 500, and this goes back about a year ago, you'll see a steady uptrend. This is the 20-day moving average and the 50-day moving average. And really the only interruption that we've had in the last year, the only sell-offs, was something that happened in early January concerning volatility in the markets. And then we also had a sell-off in March over fears of trade. Now, the trade wars were something that was looming over the market for some time, and then investors started to believe that these would come to an end quickly, that there would be no mutually assured destruction, and the uptrend would resume. So investors aren't really thinking about any upcoming trade wars with China at this current moment. Now I look at the Fear and Greed Index. This is published by CNN Money, and it's flashing extreme greed for the first time in several months. And even though sentiment is in extreme greed, you can still have a rally. You can still have a sell-off when things are in extreme fear. This is just something to think about that's flashing a caution sign. You don't want to be a buyer when everyone else is in a state of extreme greed. So that's the backdrop we're looking at right now. Now, what could possibly go wrong? Well, on September 5th, which is just a week from now, the trade officials' public comment period ends. And this is interesting because last week, the talks between U.S. and China ended with no signs of progress. Now, you might be wondering, if China is such a big export country, why are they not willing to come to the table with the United States and resolve these trade disputes? Well, a lot of it has to do with the position that China is in right now. And for the first time in about 15 years, Chinese share of exports as a percent of GDP has decreased significantly. Back in 2007, exports made up about 35% of GDP. Currently, it's down to about 18.54% in 2017. Additionally, Beijing has announced a Made in China 2025 plan, which will see them ramp up technology products such as semiconductors, artificial intelligence, and robotics. So if the U.S.-China trade war does escalate sometime in September, I think one of the first things you'll see is the Chinese start to sell some of their holdings of U.S. Treasuries. Now, right now on this chart, you can see that China has been a net buyer of U.S. Treasuries since about 2000. And the reason they do this is because obviously they export goods to the United States, and after they sell products to the United States, they receive dollars. They then turn around and take those dollars and invest them in U.S. Treasuries. But right now they've accumulated about $1.4 trillion in U.S. Treasuries, which is about 8% of U.S. total outstanding debt. And we could see China move to start selling Treasuries, which could put upward pressure on interest rates at a time when the economy might be feeling a little bit of fiscal drag from the effects of the tax cuts wearing off. So this is something really to keep in mind as we move forward. Remember, the market backdrop is extreme greed. We have a very extended rally right now, and we've got this looming September 5th deadline coming up right now. Everything looks rosy after the Trump NAFTA agreement was settled, but I still think there is some caution in the environment moving forward. That's it for now. Thank you very much, and have a great week, everybody.